Hello, good morning, and welcome to today's live technical analysis. We're going to be starting off with the euro. In terms of financial releases, we're noting the flash GDP rate for Q4, so the revised GDP rate for Q4 for the eurozone, which came in at 0% approximately 6 minutes ago. Now, the euro may have moved lower. Well, it moved lower during yesterday's trading session following the release of the US CPI rates. And you can see that's probably that bearish candle right there. But in terms of the financial releases, about 7 minutes ago now, the 0% means that the Eurozone's economy appears to be stagnating. So that might add to downward pressures on the euro. The industrial production rate, though, came in higher than expected, at 2.6%, if I'm not mistaken. I've just seen the rates. And as such, could alleviate some of the downward pressures on the euro. Yet, heavy emphasis on the GDP rate, which could actually weigh on the euro despite coming in as expected. That's concerning for the eurozone's economy, and as such, could further weigh on the euro. Now, in terms of all pairs denominated in the US dollar, so affiliated USD JPY, the Loonie cable, the dollar CAD, etc., CPI rates yesterday from the US implied at persistent inflationary pressures remaining entrenched in the US economy. So, what does that mean? Well, if you're expecting the CPI rate to decrease at, let's say, 3.5 and comes at 3.8, even though it's the same rate as the prior reading, it's still persistent inflationary pressures. Therefore, the hawkish rhetoric from the Fed appears to be validated again and again and again. We're noting the past 2 months, the employment data for the US has been better than expected. Look at the NFP, look at the average hourly earnings rate as well. Unemployment rate still strong. Therefore, in combination with the CPI rates, the hawkish rhetoric from the Fed, in my opinion, will remain and could even intensify. And when I say intensify, we've been saying this for the past few months. You can look at our prior live technical analysis sessions. 6 rate cuts that were expected by the market were over optimistic. It is now down to four. So from six, we've gone down to four. And I would go as far as to say that I expect them to go down to three, which would coincide with the Fed's dot plot. So that appears to be weighing on the stock markets and providing some support for the greenback on expectations that the Fed will keep their interest rates higher for longer, which is a rhetoric that we've been saying for quite some time now. In terms of technical analysis, in terms of the euro, broken below our support level that we had placed yesterday together. So breaking below S1. So this is resistant, a support turn to resistance. I would maintain a bearish outlook for the pair from a fundamental point of view as well. Overall, it looks like the ECB may have to cut rates earlier, monetary, excuse me. The ECB may have to cut rates earlier than the Fed. And if the Fed is keeping their interest rates higher for longer, could provide support for the greenback. And this becomes R3, 1.0795. That's R2. So we have support turn to resistance, readjusting our resistance levels as well. For support, we need to find S3. Technical point of view was moving an upwards moving. We had an upwards moving trend line. Could be a descending wedge. Well, a wedge moving higher, broken below approximately 3%. Could validate it as well. Next target for the bears could be S1 at 1.0620. RSI running along the figure of 30, implying a bearish market sentiment. Now let's back. We can readjust our S1 1.0665. So S1, we can keep S2 there. The distance between R1 and R2 is fairly close to each other in comparison between R2 and R3, but that's okay. It's just turned to resistance, so for a bullish outlook, would have to break above R2 as well. But we'll have a look at that in just a moment. And now we need to go back and see where we're placing S3. Old high. Distance close. bit too close, but perhaps. And then we should simply readjust our support and resistance levels. It's too far away. Since we're doing this on a daily basis, me placing the level that far low, still valid, but maybe there is a better option for a more immediate support level. So we have S1 1.06650. If we bring S2 at this point here, let's see if we can if that coincides with this bearish and bullish candle. Partially yes. Look above support. So in theory, this could be a support level, although in all honesty, I'd prefer my support level to have been around this point here, but nonetheless, could be valid as well. And then you have 1.0540. So let's place this as S1, 1.06650. 0. Have support. We'll look at cable in just a moment as well. Had the CPI for the UK. For this particular pair, maintaining a bearish outlook, RSI broken below support turned to resistance. Therefore, bearish outlook must break below S1. Next target S2 1.0540. 0.0425. That's my S3. Cable. So once again, broken below our upward moving trend line, broken below two support levels. So this would be resistance. And then keep this as R1. So that's close to each other. R1, R2, R3. UK CPI rates came in lower than expected, implying easing inflation pressures in the UK's economy. Such less need for the BOE to maintain its hawkish rhetoric. We're coinciding our second support level between this point here. Note how many times it attempted to break above, but failed to do so and then moved lower. And once it did break above, it moved much higher. So this would be my S2. 1.22 or 1.230. And then for S3, on this point here, 1.20625 is too far away. So for a bullish outlook, we'd have to break above R1 and R2. Bearish outlook, simply breaking below S1 would be sufficient, as it would have to travel a significant distance before breaking below S1, so could be maintained. S3, 1.220. 220. So this is my S3. My S2, 1.230. S1, 1.2445. R1, 1.2580. R2 1.2655, and then R3 1.2760. So once again, lower than expected CPI rates, easing inflation pressures translates into a weaker pound, as the need for the BOE to maintain its hawkish rhetoric may be diminished. Bearish outlook, breaking below support into resistance, aiming for S1, breaks below, next target S2 1.230. RSI 35, implying a bearish market sentiment as well. Dollar CAD finding support on our resistance level, which is now support. I will look at that in just a bit. When we're looking at the dollar against the JPY, tomorrow we have Japan's GDP rate, which is due to be released in the Asian session. Now it's expected to come in higher than the previous rate, which could provide some support for the JPY. So this becomes R1. If I'm not mistaken, we need to extrapolate the distance once again to find our new R3. Now it comes in better than expected, or as expected, could provide some support for the JPY, perhaps a reversing trajectory, aiming for S2 148.88. Comes in lower than expected, could potentially weigh on the JPY. So for this particular pair, impacted during tomorrow's Asian session, that might be interesting if you're awake at that time. In terms of R3, extrapolating the distance, 171.13. Or 155.5, just to be on the safe side. Big figure, equal distance. So it's about $2 difference. Big figure as well. So you have the psychological impact as well, playing into the resistance level. So we've got R1, R2, R3, S1, S2, and S3 as well. Overall, validating our upwards moving trend line since here, which was on the 2nd of January. I feel like this could be a steeper upwards moving trend line as well. So would maintain a bullish outlook. RSI above 70 might be due a small market correction back down to S1 before continuing on its ascent. In terms of the dollar, Chicago Fed President Goolsbee is due to speak later on today. Now, if he's hawkish, and he's known to be a dove, so if he's slightly hawkish, could provide further support for the US dollar. Let's look at oil. Oil prices appear to be moving higher. So we still have our support and resistance levels. It's continuing to validate our upwards moving trend line. Bollinger Band is tilted towards the upside. RSI at 67, so close to 70. Once again, implying a bullish market sentiment. So maintaining a bullish outlook if it breaks above R1, 79.15. Bearish outlook if it breaks below S1, 75.65. In terms of gold, look at this reaction after the CPI rates. It's broken above our support level, so support and resistance. Bearish outlook for the commodity, so gold. Taking aim for S2, 1,972. So this becomes R1. When we're looking at Coca-Cola, also had better than expected earnings. So that may have provided a boost for the company stock price. But I have not looked at it today, so we'll have a look together, see what the reaction was. Have S2 turn to S1. S3 becomes S2. And then for S3, let's go back. Let's see if we can find a low or a higher high in between here. So I'd say just create a shape. So this was an old high and an old higher low. So higher high, higher low. Now, somewhere around here, I would expect to find support. So why am I placing it at the old higher high instead of the old higher low? Well, in all honesty, it's closer to S2. I placed here, it's a bit too far away. So if it does manage to traverse down to S1 and even below S2, the bearish sentiment could wane before it reaches this point. So I'd rather opt for support level that's a bit closer to my S2. Does not mean this is not valid. Just means that it might find some more support here and might fade out, perhaps trying to wick down. But that remains to be seen. At this point, we would maintain a bearish outlook for the precious metal. Look at the RSI, 26, so strong bearish market sentiment. So it becomes S3. Now, if it does manage to reach S3, that would be significant. But for now, target is S1, 1,972. Lower than that, 1,930. Now, for a bullish outlook, we'd have to break above R1. Now, with the steepness of the move following the release of the CPI rates, it would not be surprising if it corrects up to R1 before moving lower. It was steep, so might accumulate sell orders and move lower at R1. But overall, maintain a bearish outlook on the precious metal. Now, the Dow Jones 30 has broken below our upwards moving trend line. So I would no longer maintain a bullish outlook on the index, this particular index. I would switch towards a sideways bias between S1 and R1. It recouped by this bullish candle. I think it will stay between S1 and R1 unless Goldsby is hawkish. If he is hawkish, we're expected to break below S1, take aim for S2, then S3. Note the RSI is dropping to 50. So sideways bias between S1 and R1. Within the next couple of days, the Bollinger Bands may actually narrow between S1 and R1. So staying in between here. Bullish outlook would have to break above R1. Bearish, simply breaking below S1. It's moved lower, broken below our upward swing trend line, and as such, could move lower if it breaks below S1. Same story with the S&P 500. Note that it's resting on S1, 4,950, S2, 4,800, S3, 4,660. RSI is dipping, so it's below 70, it's at 62, implying some bullish tendencies remain. Yet, it's at S1. If it breaks below S1, would maintain a bearish outlook for this index as well. It's broken. Look at it from two ways. You have two upwards moving trend lines. If this is broken and it moves to the mid-range and takes aim for S2, it would have broken two upwards moving trend lines, and as such, could break below S3. I would maintain a bearish outlook. Why? Why would I maintain a bearish outlook? Well, I've said that the market expectations are 4 rate cuts, with the first starting after May, which was the prior anticipation before the release of the CPI rates. So if I'm expecting it to be 3, the market expectations, and the rate cuts, that means I'm expecting the dollar to strengthen. That means I would be bearish for the S&P 500, Nasdaq 100, and Dow Jones 30. So we're all maintaining a bearish outlook on all 3 indexes. Now, for the Nasdaq, the story is slightly more different. Still validating our upwards moving trend line. So one could have said that, yeah, this is a correction. But based on what we're seeing, I would maintain a bearish outlook. Technical implies upwards, so Bollinger Band still to the upside. RSI 60, so some bullish tendencies. Hasn't broken below our upwards moving trend line. But if I'm expecting 3 rate cuts instead of 4, would maintain a bearish outlook for the Nasdaq 100. If it breaks below S1, switch towards a bearish outlook. If it does not, sideways between S1 and R1. Lastly, for a bullish outlook, simply has to break above R1. Still remaining sideways for Boeing, Nvidia. Readjusting my support level, 700.40. We had said that this was too narrow. $613.10 for S2. Could be a reversal pattern in the formation being formed. RSI 81 implies it's overbought, due a market correction lower. Bearish outlook would have to break below S1 and S2. Otherwise, this could be the market correction down to S2. Still validating the upwards moving trend line, but if the Nasdaq moves lower, expect it to be driven by Nvidia as well. Netflix, if it gaps down below, I'll reversal pattern. 50, so sideways between S1 and R1. But if it breaks below S1, would switch for a bearish outlook. Apple, seemingly side below 50, close, so it's 41, so bearish tendencies. Sideways bias between S1 and R1, breaks below S1, then bearish for up until S2, 166.80. Tesla, sideways as well between S1 and R1. ExxonMobil, broken below S1. Bearish outlook, should it manage to move lower. We'll have a look in just a moment though. Let's look at Coca-Cola. Let's move on to the daily. Moved lower yesterday. Surprising considering that they beat earnings expectations. Could be some concern with the forward guidance perhaps, but note how it's resting on our S1 level, 58.77. RSI 44, so there are some bearish tendencies within the market. We can readjust. Well, it's broken below our upwards moving trend line. So I'd switched for a sideways bias between S1 and R1. If it breaks below S1, bearish for S2, and then taking aim for S3. If it manages to break above R1, then I would switch for a bullish outlook. But from what I'm seeing, would not be surprised if it stays in between this range. I'm going to be highlighting with a very nice rectangular box. So I would not be surprised if it stays in between this range, unless something occurs. ARM. It's been a while since we've looked at ARM. Let's move into the daily. Wow. ARM, we might have to move on to the forward chart, and everything we had is essentially unusable, to say the least. Much hype around the company, so that better than expected earnings boosted the company's stock price. It jumped. So where's our support and resistance for the company? If we move on to the 1 hour time frame, it might be better. I always like using the 4 hour and the daily, but for this company, we're going to be moving to the 1 hour time frame. So S1 122.50, 0.45. Then S2, taking these candles, and then try to wake up. So one could say that that is actually resistance. Then taking these closed and opened and moved lower, 156.15. But then R2 and R3, This is a difficult stock to chart because I'm placing my R1, let's say here. It's too close to my S1. It's too close to R1. So let's say I brought it slightly lower, around here. Close, but not too close. Where would I place my S2? Here, on the 3.80. And then my S3 would have to be at the highest point, 78.43. So you can see R3, R1, R2, R3, S1, S2, and S3. Huge differences. And we're on the 1 hour time frame as well. Nonetheless, sideways bias, but between S1 and R1 could easily be broken. So it depends. If it breaks below S1, switch for a bearish outlook down to S2, 103.80. If it manages to break below S2, then it might try and fill this breakaway gap that was formed. So once again, I'm gonna try and fill this gap here, so it could try and reach down here. If it breaks above R1, bullish up until R2. Sideways bias has to stay between S1 and R1, but I don't really see that happening. Depends. Time will tell. Let's look at something else as well. We've done oil, we've done gold, we've done the indexes, we've done Boeing, we've done Nvidia, we've done Netflix, we've done Apple as well, Tesla. Let's go back to Forex pairs, dollar CAD, resting on my R1, which is now S1. So valid support. Manages to break below S1. Next target being S2, 1.3410, as you can see on your screen. So this becomes S2. This becomes S3. R1, R2. And that's let me just zoom in. And it has now broken below S1. So as we were talking, the support level is now invalid. It's broken below, so I'll have to bring R1 slightly higher because it's going to be moving lower, I am expecting. Moving higher S1. So we're readjusting our support and resistance levels. 1.3450. So this is S1. This becomes S2. We need to find S3. And S3 becomes 1.3185. And then I have R2, R3 already. Replacing R1. 1.3570. So you have R1, R2, R3, S1, S2, S3. It's broken below my resistance, certain support, now turned resistance line but we have removed and opted for a better resistance level where it did meet resistance. And as such, I would maintain a bearish outlook for the pair if it breaks below S1, and then potential target being S2 at 1.3320. RSI still at 60, so some bullish tendencies. Now, the CAD might be gaining once again due to oil. Oil prices have been moving higher, so it could be supporting the Canadian dollar, given that Canada is an oil exporter. The Aussie, we have Australia's employment data tomorrow. Now, if it manages to break above 0.6475 that we've denoted here, this would be support turn resistance, turn back to support. So it depends on this candle here. So I'm keeping S1, S2, and S3. I have R1, R2, R3. Now, Australia's employment data is expected to showcase mixed results. Unemployment is expected to tick up to 5%, and then 5% or 4.9%. And then you have employment, which is expected to increase, so employment figure. Now, I'd place more of an emphasis on the unemployment rate rather than the employment change figure. So if the unemployment rate comes in as expected or higher, it could weaken the Aussie, so downward pressures on the Australian dollar, taking aim for S2, perhaps even S3. Whereas, should it come in lower than expected, implying that the Australian labor market remains relatively tight, could provide support for the Aussie, staying between S1 and R1 in a sideways moving channel, given that the dollar is also strengthening. So that's it for the Aussie. Sun Mobile, 100.60, taking these 2 wicks, readjusting S1, S1, S2, S3, sideways between S1 and R1. If the next 4-hour candle does not break below S1, sideways bias. Breaks below S1, bearish, taking aim for S2. Breaks above R1, bullish, taking aim for R2, 109.10. BNP Paribas, BP, British Petroleum, not BNP Paribas, British Petroleum, BP, side 59. Some bullish tendencies, perhaps, but it needs to break above R1. It does not. Sideways between S1 and R1. UBS continues moving lower. Bearish outlook. You have breakaway, perhaps measuring an exhaustion gap, so it might be due a correction higher. Testing might test S2. New Zealand dollar finding support at 0.6015 that we have placed. Sideways bias for the pair. For the Kiwi, staying between S1 and R1. And with that does it for today. And thank you for watching, and I'll see you next time.
Everyone, my name is Emily. In our video today, we will talk about why having a forex trading strategy is important. Trading on the global forex market presents the opportunity for a quick profit turnaround for traders and offers significant potential. However, as the most liquid market in the world, it is both complex and highly competitive. This means that in order to be successful, you need to have a solid trading strategy in place. Forex can be traded in numerous ways, so it is very important that you go with an approach that suits your experience level, budget, and trading goals. Having a proper understanding of the market you're entering into and the strategy that is needed can be the difference between trading success and failure. Choosing a forex trading strategy is similar to buying a new car. There are a lot of choices and they come in different types. It is also important that you test drive a new strategy via demo account before proceeding with it on the real world markets. Thank you so much for watching us today, guys. Bye-bye.
Possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. So, disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of this material is strictly prohibited. Okay, so I'm Melanie and I will be your speaker for today. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. Okay, so here is our agenda for today. So before we get into Elliott wave theory, I just wanted to do a quick recap on Fibonacci because you can't really get into Elliott wave theory without actually fully grasping your Fibonacci concepts. So because it's been a while since we've done our Fibonacci series, I thought we would spend a couple of slides to talk a bit about our Fibonacci techniques. Then we'll get into Elliott wave theory, look at the different types of waves, and a few shapes. So there are a lot of different shapes, about 50 plus if I'm not wrong, but I'm just going to be going through 3 or 4 in this session. Okay, let's get started with our Fibonacci now. So these are the Fibonacci numbers that we typically use. So if you've been with us before, you would know that we use 4 different types of Fibonacci. We use the Fibonacci retracement, which is the numbers that's in between, so 23.6 to 78.6. And then we have the Fibonacci extension, which is the 127 to 161.8. And then we have Fibonacci expansion, which is the negative 61.8 and negative 27.2. Okay, in this GIF that I've included here, we are just showing you the Fibonacci retracement, which is the most basic form of Fibonacci. Okay, I'm not sure why my projections GIF isn't showing up, but I will go into depth what exactly projections are in the later slides. So firstly, we can look at the retracements that I went through earlier. I mentioned earlier, only consists of a starting point and an ending point. So you can see the point 1, point 2. What's important to note about this is basically just to follow the shape of the chart. So you can see it's pretty clear shape, clear cut shape, and actually for all of the Fibonacci, we highly stress on following the shape of the charts. Next, let's take a look at expansions. So expansions are the negatives of the range of Fibonacci numbers that we use. So if we take a look at the expansions GIF here, you can see we have 3 points that we take note of, one starting point and then an ending point. So for expansions and extensions, these both use the Fibonacci retracements tool on TradingView and on MT4 as well. Only the projections one that requires 3 points, then we use the Fibonacci extension tool. So it's a bit confusing at the start, but basically these three, we use the same tool, the Fibonacci retracement tool. So we have a starting point here and an ending point. And our third point is just to make sure that we retrace at least 50% of the chart. So typically expansions and projections are used together, and we want to look for a flash kind of shape. So you can see here in the chart, we have this lightning bolt kind of shape, or some people call it like a Harry Potter kind of shape. So that's what you want to look out for when you're using expansions as well as projections. But I'll give you a couple of examples later on. Next, if we take a look at extensions, this is what we call the Nike tick Fibonacci method. So we have a starting point and an ending point, which is the head of the tick. And then it has to retrace at least 100% of the head of the tick to be considered a tick. Obviously, the tail has to be longer than the head. So this is what we're looking for. Extensions, we use the more than 100% values of the Fibonacci range. Okay, let's take a look at a couple of examples in the charts so that's a bit clearer. So here, we have all of the 3 ranges for you to take note of. So from 0 to 100% is the range of Fibonacci retracements. Then we have the positive Fibonacci retracements, more than 100%. Not included here is the 161.8 as well. So it's important to take note of that if you are using the Nike tick. Next, if you see me looking to this side more, it's because my monitor is on this side. So yeah. And then on the other hand, with the negatives, is our Fibonacci expansions rather. And this is the negative 27.2 and the negative 61.8. So let's start off by looking at the Fibonacci retracement method. So we have the starting point over here and the ending point here. And as you can see, I'm looking at where price has retraced, hence the name Fibonacci retracement. So over here, I've highlighted this area in which price has bounced off of, and this is the 61.8 area. So we take note of this level because price has reacted off of this specific level. So that's an important level for us to take note of. So what we like to do is once we've identified a specific level, because it can get quite messy if you're looking for Fibonacci confluence in which all of the different Fibonacci's line up in the same area. So what we do is once we've identified an important area, we just get rid of the other levels and just solely take a look at this one highlighted number. Here's another example of a Fibonacci retracement. So I have our starting point here, ending point here. My 38.2 is at this overlap support level at the 32544.21 level. So it's an overlap support because we have a swing high. Oh, we have a swing high that has that's at the same level as a swing low. So it's basically where the bulls and the bears respect a specific area. So at this overlap support, we also have the 38.2% Fibonacci retracement that lines up with that area. That's why I've highlighted it here. Okay, another example here. So here I have two levels that I've highlighted to show you guys briefly how we use Fibonacci retracements to support our resistance and support levels. Okay, so firstly, let's take a look at this 61.8 that lines up with my resistance at the 0.92637 level. So at this level, it's obviously a swing high resistance with the swing high highlighted here. And then using our Fibonacci retracement, I've noticed my 61.8 lines up with this level and price has reacted off of it nicely, which is why I've just kept that level. And then I pull out another Fibonacci retracement from this swing low to this swing high here in order to find a retracement level that lines up nicely with my swing low support. So this is a multiple swing low support with 1, 2 swing lows lining up nicely. This is at the 0.91614 level. Okay, so and then once again I can see that my 61.8% lines up nicely with that same level, which is why I've highlighted this area here. Okay, so I hope that's been pretty clear on Fibonacci retracements. Pretty straightforward method to use. So, but let me know if you guys have any questions throughout the webinar. Okay, if there are no questions, we can move on to our next Fibonacci recap. Okay. Okay, so the time frame, we typically will analyze on either the 1 hour or 4 hour time frame because the shorter time frames, like the 5 minute, 15 minute time frame, those tend to be a little bit more noisy. So we stick to the middle for 4 hours or 1 hour, depending on how clear the charts are. But it really depends on your own trading strategy. So if you are a swing trader, you might prefer a longer time frame. If you're scalping, you might prefer a shorter time frame. So it really depends on you, but we just stick to the middle whenever we are analyzing. Okay, so next, let's take a look at Fibonacci expansion. So once again, expansion, we are looking for a flash symbol or lightning bolt symbol. So you can see here, in the example I've included, we have a starting point over here at point 1, and then at point 2, we have the ending point. Point 3 is where we then start to analyze whether price has retraced at least 50% in order to form that flash or zigzag shape. So in this example, price has retraced up to the 61.8% level. So that's how I know it's more than 50%, definitely more than 50%. So I can use it to predict or to forecast where price is going to come down to. So I can see here, at my last arrow, I'm expecting price to come down to this negative 27.2% level. And I'm expecting price to bounce off from this level. And we've included support because it could be a possible support level. Okay, so for Fibonacci expansions, we are looking at the negatives, mainly negative 27.2 and negative 61.8. Okay, and then we can see the outcome of what we have analyzed in the previous slide. at the negative 27.2 support level, price really did bounce up nicely off of the Fibonacci retracement. Okay, and then a pro tip that we have included here is that price usually does come back to its ending point, which, as you see in the beginning, at point number 2, that's where our ending point is at. Okay. Next, we're looking at over here we're looking at the Fibonacci extension. So like I said, this is a really quick just kind of recap before we dive into Elliott wave theory. But I just thought that in order to really understand Elliott wave theory, you really need to have your Fibonacci techniques in check. So it's been a while since we've done our Fibonacci series, so we're just going to do a quick recap here. But if you have any questions, feel free to let me know. Okay, so next we're moving on to our Nike tick or Fibonacci extension. So the extensions we're looking at are the 127.8, I think, and the 161.8. Okay. Here you can see very clearly that we have an upright Nike tick. You can see exactly the shape of the tick, but it can also possibly be upside down. I think I have examples later on to show you guys an inverted Nike tick, but it's basically the opposite of this, but upside down. So it's like the head here and then the tail is longer. So starting point here, ending point here, we always want to make sure that we're looking for this V shape. And an important point as well is that you want to make sure that it retraces fully the 100% here. So it has to fully retrace it and go beyond the 100% starting point. So you can see over here in this example, it has retraced more than 100% and it has moved up to this projected level at the 161.8% level. Okay, so it's at this 161.8% projected level that we are expecting a reversal off of this level. And you can see that's exactly what it did. So not included here is the 127% level, which would be somewhere over here. So once price has broken out the level, then you can expect price to reverse off of the 161.8. Before it reverses off the 161.8, you may expect it to either break out of the 127 or like it did here, or also reverse off the 127 level. Okay, here is a GIF to show you guys what I mean. Okay, so we can see here price is currently at the 127.2% level. Okay, so if you watch closely, price did kind of test this level a bit before breaking out of it. And then once it breaks out of it, then we can expect a really nice bounce off of the 161.8 level. Okay. So let me know if you have any questions on the three Fibonacci methods so far. If you are a little bit confused, let me know as well. But we cover all of these in depth in our Fibonacci series. So not to worry if you are a little bit confused, if you've missed those. I think we will probably do those again sometime soon. So yeah, you can keep an eye out for that. Okay, let's move on. So next we're gonna be taking a look at Fibonacci projection. So we have Fibonacci projection actually uses the Fibonacci extension tool and not the Fibonacci retracement tool like the other two um that we've like the other three methods that we've looked at previously. So this is because the Fibonacci projection uses 3 points that only the Fibonacci extension tool provides. So for Fibonacci projection, we use the 61.8, 78.6, and 100%. It's mainly those three, but you can also use the 127.2, 161.8, and the 200%. Okay. Pro tip, once again, for Fibonacci projection, we are also looking for a flash or zigzag kind of shape. So very often the projection and expansion tools rather, the ones that both use the flash zigzag shape, those are typically used together to find a confluence area. Okay, now let's take a look at a couple of examples of this. Okay, so here's an example of a Fibonacci projection analysis. So we have a starting point here, middle point here, and ending point here. And you can see very clearly this flash shape. So this Fibonacci trend line, as I mentioned earlier, should follow price movement really closely. So follow the shape of the market basically. Okay, so in this other example, we have the starting point, middle point, and ending point, and we are projecting this price to bounce off of a specific level. So we can see here we have identified this 78.6% Fibonacci extension. And this is extension we're looking at. As I mentioned, always look out for the zigzags. And you can see price really bounced off of this 78.6% Fibonacci extension. Okay, so here is the before where we are using the projection, Fibonacci projection. So it's a little bit confusing because the method is Fibonacci projection, but we are using the Fibonacci extension tool that's on MT4 and TradingView. So as long as you remember that projection uses 3 points, I think you're good to go. So starting point, middle point, ending point, these are the 3 points that we're using. Remember this shape, this zigzag shape, and then the 78.6% Fibonacci projection that we are expecting. Then you can see price really bounced off of this 78.6% Fibonacci projection level. Okay. Next, let's take a look at another example. This is another kind of shape of the zigzag. It's inverted now. So we have a starting point, middle point, and ending point that follows the shape pretty closely. And then we are projecting price to hit the 100% Fibonacci projection. So we say that the 100% level is one of the most powerful levels because price is most likely to hit those levels. Okay, and you can see that's exactly what happened. Price reacted off of the 100% Fibonacci projection level, just as we expected. Okay. Okay. Now that we know how to identify um, some Fibonacci levels, let's take a look at how you know when is considered an invalid Fibonacci retracement. So when does a Fibonacci retracement become invalid? So one of the most common scenarios of this is when price makes a lower low. So if there, assuming you are drawing Fibonacci retracement from the top to the bottom of the picture. So as I showed you guys in one of the GIFs, price made a lower low from, or rather, we're drawing the Fibonacci retracement from the top to the bottom. So that's what we need. So an invalid Fibonacci retracement happens when price makes a lower low. So the lowest point or the ending point is no longer valid. So that's just basically what it means. So if there are bars on the right that break your ending point, it then becomes invalid. So there are Fibonacci retracements that are negative. So the negative 27 and negative 61.8 that we use for Fibonacci expansion. And we'll touch on these as they basically go beyond your ending point and yet they are still valid. So we already talked about those in a couple of the slides before. So here's an example of an invalid retracement. So you can see the starting point here, ending point here, as I've highlighted. And because price has broken below my initial ending point, it then becomes invalid. Okay, as long as it breaks below the 0.0% level, it's invalid. Okay, so it's important to always remember to pick the lowest point with nothing to the right of your ending point. Okay, that kind of brings us to the end of our recap for the Fibonacci section. So let's get into the introduction for our Elliott wave theory now. Okay, let me know if there are any questions so far. Okay, seems like we are all good. So Elliott wave theory is a really popular approach to analyzing financial markets, particularly in trading. So it's based on the idea that price moves in repetitive patterns that's driven by investor psychology. So it's developed by Ralph Nelson Elliott in the 1930s. And the theory suggests that the market movements can be divided into a series of waves that follows a specific pattern. So these waves reflect the alternating dynamics of market optimism. So those would be bullish phases and market pessimism, which would be bearish phases. So it's basically a method of analyzing cycles in the market. And by analyzing these price movements, you can then forecast future market movements. Okay, now let's get into the different types of waves. So the first type of wave that I want to touch on is, so this is what a typical Elliott wave looks like. So it's pretty theoretical, so bear with me in this part. So firstly, we have the impulsive phase or impulsive waves, or we even call these motive waves. So many names for it, but it's basically the parts of the wave that are trending. So Elliott proposed that market trends consist of 5 waves in the direction of the primary trend, followed by 3 corrective waves. So these waves are known as impulse waves and are labeled with numbers 1, 2, 3, 4, and 5. So I have included in bullet points to show you guys just to make it a bit clearer. So wave 1, this is the initial wave in the beginning of the trend. So it's often seen as the beginning of a new move after the previous correction. So this wave, wave 1 is typically not very strong yet. Next, let's take a look at wave 2. Okay, so after the initial rise of wave 1, there's typically a retracement or correction in wave 2. However, wave 2 doesn't usually retrace the entire movement of wave 1. Next, wave 3. So this is often considered to be the most powerful and the extended wave in the sequence. So it tends to be the strongest move in the direction of the trend and is typically longer and more dynamic than waves 1 and 5. Okay, so this impulsive phase, I forgot to mention, we're talking about the numbered phases here in the image that I've included. Okay, next, let's take a look at wave 4. So at the number 4, following the strong move of wave 3, there's another corrective wave in wave 4. Similar to wave 2, this wave retraces part of the movement of wave 3. So this is all leading us to the final wave 5. So this is the final wave of the trend and represents the last push in the direction of the primary trend. So it's often accompanied by reduced trading volume and can show signs of exhaustion. Okay, so next, let's take a look at the corrective phase and the corrective waves that are part of this corrective phase. So those are the next part that we're going to be talking about are the lettered ABC areas of the wave. Okay, you can take a look in this image as well. It's not so crucial to follow exactly the percentage. So once again, these use Fibonacci levels, which is why I thought it was important to recap on the Fibonacci techniques earlier. But all of these percentages are from Fibonacci, and it's important but not crucial points for you to follow exactly the percentage of the retracement. Anyway, let's get into the corrective waves. So after the 5 impulsive waves are complete, the Elliott wave theory suggests that there will be a 3-wave correction against the primary trend. So these corrective waves are labeled with the letters A, B, and C. So wave A, this is the first corrective wave after the completion of wave 5. So it's a counter trend move against the primary trend. So you can see here wave 5 is upwards. Wave A counters that upward movement. Okay, wave B, after the completion of wave A, there's a partial retracement in the opposite direction, as you can see here. So the partial movement is about 50% or 61.8% of wave A. However, wave B doesn't usually retrace the entire movement of wave A. So again, about 50% or 61.8%. Okay, next we have wave C. So this is the final corrective wave and is often the most dynamic of the 3. So it moves in the direction of the primary trend and can be quite strong. Okay, so once again, the percentages are not crucial to take note of, but it's important to maybe remember some of them. But what's more important is the 3 main rules that I'm going to be talking about in the next slide. Okay, so here are the 3 main rules, and these are really important rules that you should remember. So you can ignore this wave 1, 3, 5 thing here, but 3 main rules that you cannot ignore. Firstly, Wave 2 cannot retrace more than 100% of wave 1. Okay, next main rule is wave 3 can never be the shortest of the 3 impulse waves. Okay, so you can see from the image I've included here, wave 3 has to be longer than wave 1 and 2. Next, we're looking at wave 4. Sorry, I misspoke. Main rule 2, wave 3 can never be shortest of the 3 impulse waves. So the 3 impulse waves that we're talking about is 1, 3, and 5. So 1 has to be the shortest. 3 can be longer than 5, but it should not be the shortest. Okay, next. Point 3, wave 4 can never overlap wave 1. So it has to be, just follow the dotted lines here, can never retrace more than the head of wave 1. Okay, the percentage over here, the 1, 3, and 5 is not super important for you to remember. These 3 main rules are more important. Okay, now let's take a look at some of the shapes. So here I've included some examples of entry and some shapes that you can take note of. Once again, there are, if I'm not wrong, more than 50 shapes for Elliott wave and harmonics. So it's a bit difficult for me to include all of the shapes, but I have tried my best to include a couple of important ones for you to take note of. Okay, so here examples of entry. We have the simple M shape and the W shape. Okay, this M and W patterns over here are a bit blurry, but it's basically the same thing. So you can ignore that. So simple M, let's take a look at this. The entry point is between these two heads of the M here. And the bottom, basically the corners of the shape M. So this is a simple M. When we're looking at an extended M, the extended M tends to be at the back of, or rather the second half of the shape. So it starts from the bigger half here to over here. So any point of this can be considered an entry point. Okay, next, let's take a look at the short-formed M. Short form, basically because the second half is shorter than the bigger half here. But for this shape, the entry point is solely at this tip of the M here. If we're looking at W, it's pretty similar here. Excuse me. The simple W will once again take into account all of the corners, and any of these 2 points can be considered an entry. Short-formed W, similar to the short-formed M, only the tip of the M can be, or the W can be considered an entry. Extended W, the highest point or the highest tip and the middle tip can be considered entries. Okay. So here's an example of a W bottom. So you don't really have to take into account all of these bars. Just really want to highlight the type or the shapes over here. So example of a W bottom here, we have, if you compare here, we're looking at a short form W, and this breakout here is our entry, goes in, and our target or profit target is over here. That's why we say that this point here is your entry, because it's the point of breakout. Okay, if we look at an example of M top, Earlier we mentioned, if I go back, we're looking at the short form M, where entry is only here. Same thing, breakout is over here at the tip. So this is our entry, and we're going in for a sell towards our target profit over here. Okay. Okay, if you are a bit confused with the shapes, I've included some images of them labeling the tips of the W patterns and the W patterns over here. Okay. So next type of shape here, we are looking at a bullish godly and a bearish godly. So the rules, in this case, we are kind of going into harmonics over here. But there are a couple of rules for this pattern compared to the previous M and W patterns. So for a bullish godly, the AB leg, which is over here, the highlighted red leg, should retrace about 61.8% of the leg XA. So that's where your Fibonacci levels come in. Then the BC should retrace the 38.2% to about 88.6% of XA. So XA is the first line here. So we're looking at BC now. And then for CD, which is the last leg of this shape, CD is at least a 78.6% retracement of the original leg. So once you have all of those rules that are in line, then you can expect to enter over here, going for buy towards perhaps the A over here or the C. Similarly, if we're looking at the bearish, all of these levels still stand, but instead we're going for a sell instead. Okay. So just another shape for you to kind of take note of if you are interested in harmonics and Elliott wave patterns, because there are a lot of patterns out there. Okay, next we're taking note of a bat shape now. So the main rules of the bat pattern are the AB leg can retrace between 38.2% to 50% of the XA leg. So the AB leg is over here, the second leg here, retrace 38 to 50% of this original leg. BC can retrace 38.2 to 88.6% of this second leg. And the CD leg can retrace up to 88.6% of the original leg. CD leg can also be an extension between 161.8 and 2.618%. So because this is a tick or a Nike tick that we mentioned earlier, a Fibonacci extension, so you could also use the Fibonacci extension over here in this shape as well. And this is the shape that I was talking about, the inverted Nike tick. Yeah, the same thing, the same levels apply, same rules apply here as well. Okay, so it's bearish because we would then be going for a sell here. Bullish because we would then be going for a buy after point D. Okay. And then for our last shapes that I will go through for today. We have the butterfly shape and the crab shape. So let's start off with the butterfly shape first. So we have the 78.6%, the AB has to retrace of the XA. The BC has to retrace 38.2 to about 88.6 of the XA as well. CD has to retrace 161.8 to 261.8 of BC. So once again, this is a Nike tick as well, or the Fibonacci extension. Okay, or the CD can also retrace 127 to 161.8 of the XA. Okay, then you're going for a sell after D. Bullish, you're going for a buy after the D. Bearish, on the other hand, we have the AB retracing 38.2 to 61.8 of XA, and BC over here 38.2 to 88.6 of XA, and CD 224 to 361.8.5 of BC here. Okay, or 161.8 of XA. Okay, so yeah, these are all of the shapes that I will go through for today. Let me know if you guys have any other questions. Like I mentioned earlier, there are a lot of shapes out there. But yeah, I'm just gonna go through a couple in this webinar, because this was quite information intensive, I think. I hope you guys are still with me. Okay, let me know if you guys have any other questions. If not, that brings us to the end of our webinar. Thank you guys so much for joining me today, and have a great rest of your week. And yeah, I'll see you guys next week. Bye, guys. Yeah, so these shapes are, let me go back. They are price action, yes. So it's kind of overlapping the price action and harmonics and Elliott wave theory as well. Okay, Jinuka, that's good to hear. Thanks, Stanley. Okay, see you guys next week. Thanks, everyone. Bye, guys. Take care.